Hello to all you passive income investors. I've got two dividend stocks here, one with a dividend yield of 6.5%, another one with a dividend yield of 8.6% that I'm going to compare in Altria Group and AT&T. I'm going to answer which one I think is the better dividend stock to buy, comparing the two on several critical financial metrics, including the dividend yield, the payout ratio, the operating profit margin, and the forward price to earnings ratio. And given my background as a professor, I like to explain these metrics instead of just giving you what the numbers are and telling you which one is better. So I'll do some of that in this video as well. And then by the end of the video, you'll have your answer on which one I think is the better dividend stock to buy. But you'll also see the numbers that I'm using to make this decision so that you can come to your own conclusion to understand which one you would rather have as the better dividend stock to buy. So let's get into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so like I highlighted, each of these two dividend stocks has a robust dividend yield. AT&T offering dividend stock investors a yield of 6.46%, while Altria Group offers dividend stock investors a yield of 8.64%. But also important is the dividend payout ratio, and here's why this is important. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now that you understand the dividend payout ratio, you'll notice that Altria Group has an 80% dividend payout ratio, much higher than AT&T, with the dividend payout ratio of 59.9%. The next metric I wanted to compare these two dividend stocks on is the operating profit margin. This measures how much profit is left over after the company generates all of the expenses in order to offer the services to its customers. So in its day-to-day course of business, how much profit is it generating? And Altria Group is phenomenal in this metric at 55.89%, and that operating profit margin has been rising from under 45% about 10 years ago. AT&T is at 20.16%, which is also a good operating profit margin, but compared to Altria Group, it looks really small. Remember, the company that I follow with the highest operating profit margin is Visa at a little over 67%. So Altria Group is right up there among the most profitable companies in the world. Now, I'd like to highlight that neither Altria Group or AT&T is expected to grow very much over the next several years. They both operate in industries that are saturated and mature, and they are not attracting very many new customers into their respective industries. So they need to get better at operating and serving existing customers, which they both have been doing very well over the last several years. I also wanted to consider and compare their balance sheet, most notably total long-term debt. AT&T with $132 billion in long-term debt. It's one of the companies with the highest debt that I follow, along with Verizon is up here with over $130 billion in long-term debt. Now, I usually say this isn't very much concerning for AT&T because it generates roughly $10 billion in annual cash flow. So it generates significant cash flow to pay down that debt, but it is a risk just in case something were to happen to stop that cash flow. It would be in big trouble because it has this massive debt load. Altria Group, only a fraction of that, still a lot at $25 billion, but only fraction of the long-term debt of AT&T. Now, to compare these two on valuation to determine which one is more expensive, I'm going to use the forward price to earnings ratio, and here's why I use that metric. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. All right, so now you've got an understanding of the forward PE ratio, and they're close here. Altria Group slightly more expensive at a forward price to earnings of 8.4, AT&T at a forward price to earnings of 7.5. So I think Altria Group has earned this premium valuation over AT&T. It has less debt. Its operating profit margin is more than twice as high as AT&T. And so I would be willing to pay that slightly higher price for Altria Group as the better dividend stock here. So my choice between these two would be Altria Group as the better dividend stock. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.